Today we're discussing a case study of a UK entrepreneur who wants to move to Dubai with his wife and family. I'm joined by two guests, Daniel Dronsfield from EER in Dubai and Sean Bannister from Edwin Co here in London. Welcome to you, gentlemen.
Thank you, David.
Good morning, David.
So we're going to set up the case study in a moment, but first I'd like to come to my two guests for a brief introduction, starting with you, Dan.
Yeah, hi. So my name's Dan Dronsfield from EER Middle East. We're a corporate service, immigration and relocation company with offices in Dubai, Abu Dhabi and Riyadh.
Fantastic. Sean.
And hi, I'm Sean Bannister from Edwin Co. I'm head of tax. We are a all-service central London law firm with about 200 people and turnover about 37.5 million.
Fantastic. So just to set up this case study, I'm going to run through the key details. We have the case of Ian and Angela. Ian is a UK entrepreneur, age 45, married to Angela, 42, also UK domiciled, with two children aged 15 and 13. They plan to move to Dubai for the start of the school year in September or in January. Ian and Angela jointly own shares in a successful UK company in the fashion industry with a turnover of £50 million a year. Ian is a director of the company, but Angela is no longer actively involved. They have an experienced management team in place in the UK. The UK company will continue to operate after they move to Dubai, but Ian is looking to start a new venture in the fashion industry in the Middle East. They own a £5 million family home in London, which will be let out initially after they move. There is also a £2 million buy-to-let property portfolio in Manchester, comprising of 8 residential properties, generating a net income of £100,000 per annum. Ian and Angela's family is based in the UK and they want to maximise the opportunity to spend time with them. So Sean, coming to you, residency is a key question here. Can you explain a little bit about their residency status and why it's important they get it right?
Absolutely, David. This is the fundamental issue that we deal with for clients that are looking to exit. Fortunately, the UK has a pretty well-defined framework for establishing residency. We've had it on a statutory basis since 2013. And in effect, what you do is you apply a series of tests, and those tests determine whether you're a UK resident, not UK resident, for a particular tax year. The way those tests are structured are a test to establish whether you were automatically non-resident, to establish whether you were automatically UK resident, or the sufficient ties test. In the scenario that we're discussing here, the points that are likely to be relevant are whether or not the father in this case takes up employment in Dubai post-exit. Obviously, he's looking to enter into a new venture, and therefore there is every chance he could be automatically non-UK resident with reference to his employment. That would mean he could spend up to 90 days in the UK, and 30 of those days could be working without triggering UK tax residence. It is fundamental to get the residence piece correct because any tax structuring and any tax planning will be completely affected and determined by the residency status of the relevant parties. And obviously in this scenario as well, we have two shareholders. So we have husband and wife both holding shares, and therefore the wife's residency position will also be relevant to any planning as well, in particular if there's a future exit. So there's quite a lot for them to consider. Hopefully it would be the case that they could rely on the automatic test. If they couldn't rely on the automatic test, then they would be looking at the sufficient ties test, and that would be an analysis of their position in the previous 2 tax years. They're continuing home in the UK, though noting that they're likely to rent that out, and that might resolve a tie for them, and any additional ties that they may have in the UK. So it's a multifactorial approach that has to be taken. In this particular case, you'd probably like to be within the automatic non-UK residence piece. I'd add to that, after a couple of years, the way that those residency tests work change. So those day counts will increase as time goes on, and potentially there will be more flexibility after the first few years of UK tax residence.
And if Angela's not actively involved in the business, it would be very easy for her to spend time inadvertently in the UK over the summertime when it's very hot in Dubai, or, so keeping aware of your day count and your limits is critical, isn't it?
Absolutely critical. And, this is where a great PA can be incredibly useful. Somebody to run your spreadsheets. It's keeping that contemporaneous data is vital. Keeping the evidential data is vital, in particular if you are going to take steps that rely on you being non-UK resident in order to achieve a positive tax outcome.
Okay, so we have a profitable UK company in the background here that's going to continue running. If it pays a substantial dividend, or any dividend indeed, what would the tax treatment be if they managed to become resident in Dubai?
Yeah, so a non-resident receiving a dividend from a UK resident company is a non-taxable event. It's generally treated as disregarded income. There is a point to consider there as it relates to the property rental portfolio, which we can come on to in a moment. But in broad terms, it should be possible to avoid a UK tax charge on the dividend, subject to, one, being able to claim disregarded income treatment, and two, not being within the temporary non-residence provisions. The temporary non-residence provisions would result in a dividend being taxed if you return to the UK within 5 years of exit. Generally, and the cautious approach to this is to have 6 complete tax years outside of the UK to avoid triggering the temporary non-residence provisions applying. That's to shop short-term residency shopping, for want of a better way of expressing it, to crystallise short-term income tax and capital gains tax advantages. So we have a prolonged exit period that's required in order to lock in that tax-free treatment. I would note, and it's important for an active trading business, that the only part of the dividend would be taxed is the pre-exit trading receipts. It won't be the post-exit trading receipts. So there's an exercise to be done there for the client to understand what their pre-exit trading profits are and what their post-exit trading profits are and what is being distributed to them. Because it may be the case that if they were just simply receiving regular dividends of annual profits and not the reserves, there is no additional tax. So things to think about there, but I would suggest that if they were doing a significant dividend of pre-tax trading profits, you have to be very, very cautious about the temporary non-residence rules.
Fantastic. And what about the sale of the shares? If they decided to, there's no immediate plan to sell the shares, but if a great offer came in and they're set up in Dubai, what would the situation be there?
Again, analogous to the receipt of the dividend. The same rules apply, and you would have a non-UK tax event. Subject to, and I would assume this is not the case, 75% of the value of that company not being comprised of property assets. There is a land-rich asset test. But in this case, we have a trading business, and therefore we would assume its value is derived from its trading activities. So you would, again, have a tax-free capital gain that would be paid out to the non-resident individual, and there will be no additional tax, again, subject to the temporary non-residence rules. One potential trap that applies is in a year where you split the tax year. So it is not necessarily the case that you will be deemed to be resident for the whole of a tax year if you split the year. So in certain circumstances, and the main one is a situation where you start employment in a different jurisdiction, you are capable of splitting the tax year into 2 parts. Now, it is important to note that you are actually resident for the whole of the year. All that happens is there is a special treatment for certain sources of income and gains in the overseas part of the year. So you are capable of splitting it. You will get better tax treatment on that overseas part. In this circumstance, a capital gain would fall into the overseas part of the year and a tax charge could be avoided on that, whereas a UK source income dividend wouldn't. So there is a potential trap there for clients who aren't thinking about the way that the split year rules work. And it's often the case that people think, well, I've split the year, and therefore I'm non-resident for the overseas part of that year. You would have to wait until at least the next year of non-UK tax residence in order to be able to receive a dividend, rather than waiting to the split year period. So there's a little bit of a trap there that people can fall into.
Fantastic. And what about the practicalities of running the UK company from offshore? He's got an experienced team in the UK. The business continues to run. He's going to join via Zoom or whatever into board meetings. But how do you see these things working in practice?
Well, it's what you're concerned about in those circumstances is we've got a UK company. It's UK corporation tax residence by reference to its incorporation in the first instance. You don't have to think about issues like central management control and strategic control, which are ways of determining whether an overseas company is UK resident with reference to where it exercises where its strategic control is exercised. So there's a point there. Dubai recognises place of effective management, which is a slightly broader concept than central management control, and also includes administrative duties as well as the exercise of strategic control. So what you would be looking to do in this circumstance is not trigger residency in Dubai. What we would generally look to do is put in place enough protections in the UK company's articles in order to prevent the exercise of strategic control outside of jurisdiction. So he would actually have to come back into the UK to attend board meetings aspirationally if he was going to exercise control in that format. it would be attractive to have a UK resident director to mitigate the potential argument that he was exercising strategic control outside of the UK. I accept that commercially it's not wholly practical to completely remove yourself as a director, but significant controls can be put in place in order to mitigate the risk of an argument being made that POEM is being exercised in Dubai, therefore you have a Dubai corporation tax resident company. The result of that, we should have a dual resident company. A dual resident company then means it's subject to tax in both jurisdictions. It has to determine its taxing position with reference to the UK-UAE double tax treaty. And the way that would work in practice is you would have to go for a ruling from the respective tax authorities under the mutual agreement procedure to determine where you were tax resident for the purposes of the treaty if you wanted to avail yourself of treaty benefits. This would be complicated and difficult. Our aspiration would be never to achieve that, so you would want to put in the controls to prevent that from happening.
Many thanks. We're going to come on to the UAE aspects in a second, but just to finish off on the UK tax points, the property portfolio, the UK properties that remain, what would your thoughts be around that?
So you've got a couple of things that you're thinking about there. Firstly, and there is an interaction with a dividend, which we'll come on to in a moment. Firstly, UK rental income held by a non-resident will always be taxable in the UK, especially for an individual. So you're going to end up with a UK tax charge and a continuing filing responsibility in the UK, unless you opt into the non-resident landlord scheme. Most clients don't opt into NRL because you get a much less advantageous tax profile for calculating your P&L. So you would continue to be subject to tax in the UK in relation to those rental returns. Those rental returns can be paid to you free of any additional tax. There's no additional layer of withholding tax, but you would have a tax charge in the UK. That income does not fall to be considered disregarded income, unlike the UK dividend. Now, you could, because these individuals are UK passport holders, you could access your personal allowance against that income. But if you want to claim disregarded income treatment for a dividend, you have to lose your personal allowance. So there would be a question to be made, there would be a question to understand on a tax year by tax year basis as to whether it's advantageous to retain the personal allowance against this rental income or to lose it because you wanted to pay a dividend out in the relevant tax year. So there'll be planning and mapping to be done about that. And again, it's just one of those areas where it's easy to make a mistake on disregarded income. And so an exercise has to be completed even though you're non-resident on an annual basis to establish what the best position is and to make the relevant claims. Even if you didn't have the source of rental income, we'd still be recommended that you were claiming disregarded income treatment to the extent that you continue to have a UK filing obligation.
Okay, thank you. Now, are there any other considerations that you'd be wanting to flag up or look at to get the conversation started?
You're going into a new jurisdiction. So all the planning that you put in place in relation to your personal wealth is potentially non-applicable to the other jurisdiction. So inevitably, these people will likely have pensions. Their pension arrangements can still stay in place. The UK-UAE does have a double tax treaty that deals with the pension, does have a pension article, and therefore payments could be made out of the pension scheme without the imposition of withholding tax, but the relevant claims would need to be made under the treaty. So there's some process and admin there with your pension and scheme providers. We are potentially changing the way that inheritance tax rules work for our pensions. And so whilst not immediately relevant, as our clients would still be subject to inheritance tax in the UK because they'd be long-term residents and they would be for at least another 10, 11 years of non-tax residency, it may be something for them to think about on whether they want to export their pension at a later date. Their ISAs, if they have ISAs, would need to be looked at. And you can't contribute to an ISA post-exit from the UK. So you could retain your ISA. Dubai would see it as a look-through, noting that obviously it would be a zero tax look-through, but it would be a look-through. They wouldn't respect the ISA treatment that applies to it. So there may be a question about whether you want to liquidate those ISAs with a view to going into a different investment portfolio, and we tend to do that before you came to the UK. We also often advise for those clients that are capable of accessing their pensions, and I don't think our clients are in this situation, but if you are capable of taking the pension commencement lump sum, take it while you're UK resident, and then avoid a potential for a double tax charge because another jurisdiction won't necessarily respect the PCLS payment being a non-taxable payment. In fact, most of the time they do not. So there's a little bit of pre-planning on what you would probably term basic UK tax planning. Then if they have anything more complicated, if they have EIS, AIM investments, VCT investments, and those types of things, you would probably want to look at your portfolio and establish how best to manage those, noting that you're going into, I think, what would be described as a more liberal tax regime. There may be things that can be done to maximize things with reference to the new regime, but what you do have to make sure is that you close out the old regime properly.
Fantastic. Well, thank you, Sean. That tax analysis has been really, really helpful. Daniel, sounds like with the right advice in place, there's great potential for Ian and Angela to enjoy their new life in Dubai very tax efficiently. In terms of the immigration routes available to them, could you just give us a sense of what the options are?
Yeah, absolutely. So, as Sean was saying, there's a bit of pre-planning and preparation that needs to go into place from the UK side. There's also considerations that need to be made when going to enter Dubai from an immigration and visa perspective. One of the sort of hot topics at the moment is the golden visa regime that's in place across the UAE. Now, there's various different ways upon which someone could obtain a golden visa. The most common ones we see would either be a fixed deposit golden visa, which means you're depositing 2 million dirhams into a local bank account. That would entitle you to a 10-year golden visa. The other one would be a property investment. So in this scenario, they have a property portfolio. They could be open to buying a property in Dubai. Again, the value of that needs to be 2 million or more. That again would entitle them to a 2-year,
which is a modest buy-in in the Dubai market, isn't it? It's not.
Yeah. I think the average price is above that.
Yeah.
for properties in Dubai. So. Yeah, both of those options we see are sort of high net worths looking at, and it's there are some nuances between them. So, for example, with the fixed deposit, you need to leave it in there for a minimum period of 2 years, upon which you can take that money back out, and you're still entitled to the 10-year golden visa. With a property, it's linked to the property. So, if you sell that property at any stage, the golden visa is then cancelled unless it's linked to another property in a certain period of time. So there are some planning considerations that need to be taken there. What are their moves? Are they going to be there for the long term? Are they going to be there for a shorter period of time, say a few years? So they're the two sort of major ones. Now, with them moving with family, for example, getting their children into school, this is where the planning comes into place. So whilst the principal, let's say, can obtain their golden visa relatively straightforwardly with sort of minimal documentation, other than the usual stuff, passport being one of them. The children would need to have their birth certificates fully attested at the UAE embassy in the UK, and also the Foreign Office in the UK. Then goes over to Dubai, where it's further attested by the Ministry of Foreign Affairs. That process can take a good few weeks to get sorted, which is really important if you're considering getting them into school, because they will need their Emirates ID and visas to do that.
Do you have people joining mid-school year, like their travel plans here aren't firmly fixed down? I mean, I know September is the main entry point, but also January. Do you see people coming mid-year?
Yeah, I mean, people come all year round. Yeah. Obviously, the goal is to try and get the full school year in place. That can be challenging for a number of reasons. One, as I just mentioned, document preparation, getting the visas in time. The second one would be the availability of school places. So it's very, very subscribed, and there are waiting lists for most schools. So what we see is, some people can't get in the first term. There are obviously people leaving Dubai as well, so that does free up spaces in the future terms throughout the year. Or someone's moved their child into a school that's not their first choice. They're on a waiting list for the preferred one. After the first term, they get a space, so they move. So there's a bit of movement around. But yeah, we see people coming all year round.
And what about the status of the children? We've got 2 teenage children here. When they hit 18, what's their status going to be going forward?
So this is another one of the major benefits of the golden visa regime. So with a normal employment visa, once say a male child hits 18 years old, they are no longer be able to sponsor under their parents' visa. Now with a golden visa, that is not the case. So obviously it offers a lot more flexibility to the family as a whole, which the kids could stay on if they want to do a university in Dubai, for example, or a master's or something like that. So yeah, it just gives them that flexibility as a family unit to sort of come and go as they please.
And on the corporate activity, so Ian's intention is to set up a new entity and has still got at 45 plenty of life in him in the business world. How could you assist him?
Yeah, definitely. Well, look, we see this quite a lot. It's no surprise that there's a lot of high net worths moving to Dubai. Whether they intend to work or not, people seem to be drawn into it because it's a really happening place. There's a lot of energy, there's a lot of dynamism, and people sort of get lured back into work. So unlike other jurisdictions in the world, the options available in Dubai are quite vast. And by that I mean in terms of the different jurisdictions available within the country. So you have about 50 to 60 different jurisdictions in the UAE where you can set up your business. Now, the main ones are free zones, the mainland in all of the different Emirates, and then you also have the well-known ones, the financial zones, so Dubai International Financial Centre and Abu Dhabi Global Markets. They cater to pretty much every type of business you're looking at setting up. So whether that's going to be a trading business, whether that's going to be an e-commerce business or a retail business, the options are there. So in this specific scenario, in the fashion industry, is he going to be looking at retail? Is he going to be looking at selling online, or is he going to be looking at trading sort of globally, import and export? So what we would do is look at what their end goal is. So let's take if they want to have a retail shop, for example. Where do they want to have that retail shop? Is it going to be in a specific area in Dubai that they've targeted? That largely drives which jurisdiction you set up in. So let's say they want a retail shop in DIFC. It would need to be licensed under the DIFC authority. And at the same time, if they want to be down in Jumeirah Lake Towers, that falls under the DMCC free zone, so they'd have to be licensed there. So a lot of options available to really cater to everyone. And it's interesting because what we see as well is some people will start a business, but it grows and grows and grows into different aspects. And with that, you have the options from a jurisdictional perspective to assist you with that.
There is tax in the UAE.
Yes.
It might come as a surprise to some people, but corporate tax was introduced. Sean obviously flagged as well. Their advice is needed. How do you work with clients who need to look at the kind of tax position of these new entities?
Yeah, so this is sort of leading on from what Sean said. This is why it's important that a client gets a good team together to be able to advise on the different aspects of things. So we'll work with the likes of Sean on the sort of nitty-gritty tax perspective. So in Dubai, the corporate tax rate is 9%, which is low on a global scale. From my perspective, it's never stopped any client coming into the region because of the tax regime. But there are considerations, and also jurisdictionally there are considerations as well, because there are some business activities and jurisdictions which would be non-qualifying from a tax perspective. So yeah, the full suite of planning with advisors is really key to ensure that all the correct bits are ticked off.
But you'd help them with that new corporate setup with banking, governance, like the administration of the entity. What's the sort of thing that you'd help them with once he gets on the ground and gets up and running with this new business?
Yeah, so again, unlike some places in the world, once the business is set up, it is actually renewed on an annual basis, and obviously filings that need to be made to ensure the entity remains compliant. If the entity is not compliant, it can present challenges. One being your labour and immigration accounts could be blocked. Therefore, you can't employ anybody or do anything with your visas for your staff. There are certain sort of local things that need to be taken into account. One would be the wage protection system, which is a government initiative where all wages for employees are registered through that. If you're non-compliant with that, again, you can have issues with visas. It's a bit changing at the moment, to be honest with you, because of the corporate tax that's come in. It's still very, very new. I don't think many people have actually filed a tax return yet. So that's all still sort of being worked through. The other day they released some new guidelines on it. But yeah, maintaining that entity is key to being able to continue to do business, and we would certainly assist with dealing with all the relevant authorities to make sure that there's no issues there whatsoever.
And the Dubai property market is well known to be booming. How can you help someone find a property? What are the stages? You're making an international move. Lots of complexity there generally, just on a personal level, isn't there? How do you help cut through that?
So it sort of breaks down into three things. So we've got the corporate side, which is getting the company set up. We've done the people immigration side, making sure they've got their correct visas, and then the last stage is getting people on the ground. And especially with a family unit, it's really important, because one of the biggest failures of a relocation is the family not being happy. Obviously, there's a lot of unknowns when moving to a country. Even if you visited Dubai many times, living there is different. That dealing with utility companies, et cetera, et cetera. So our relocation team, we will do a sort of deep dive into what they want from, say, a property perspective. But it links into also the schooling. So, it's no secret, traffic in Dubai at the moment can be a bit busy. So, you don't want to be traipsing all the way across the city to take your kids to school in the morning. So, you've got to look at, where the kids are going to school. That largely dictates where people live, because there's various different communities dotted around the different schools. Another thing which I think is one of the great things about Dubai, there are different areas you can live in for different experiences. So say you want the real city living, you can be in Business Bay, downtown, DIFC. That gives you that aspect. If you want the more beach living, you've got the Palm, which has got, load of beaches and villas and apartments right on that. Or you've got the more sort of community feel, which would be in one of the various, sort of golf club communities. So people can have that as well.
So if Ian and Angela are coming to see you next week, Sean, they're coming into your offices in Lincoln's Inn, what are the kind of things you'd like to impress on them? What are the top priorities, do you think? Or what are the questions you might also pose to them at that time when they're exploring this in more detail?
I think the first thing to say, and we do have this conversation with all our clients, is these moves shouldn't be about tax. They should be about lifestyle and what you're looking to achieve for you and your family. If there are some ancillary tax benefits, fantastic, take them. But the first thing to do is, and you quite rightly point out, the first thing to do is make sure that those lifestyle things are put in place. So definitely do that. I think quite right that you need a trusted partner to help with that transfer. There's so many things to consider, and especially in a jurisdiction that is fast evolving, I think probably the best way of expressing it. You need somebody who's on the ground that has that experience. It isn't like a move to continental Europe where it's pretty well known as to how things happen. Fast evolving, lots of change, and I think having a trusted partner is essential to that process.
Fantastic. And Daniel, you're in the right spot at the moment in the sense of there's huge amounts of inbound, high net worth clients. Do you see that trend continuing? Is there, continued optimism, I guess, about the UAE is the mood music, isn't it?
Yeah, there's a lot of optimism, and obviously being in London this week as well and chatting to people on the ground here, a lot of their clients are considering the move over. I think if you look at the why is that happening, it's mainly down to the options that are available to people. They've made it very easy for people to move to the country, to bring their money in, to bring their families. And if you look at other parts of the world, the UK, for example, they've made it a bit more challenging for these high net worths. So yeah, just creating that environment where people have options. As long as they continue to do that, I think you're still going to see people coming over.
Just on that particular point, I think one thing that the UK does have, obviously, I think our immigration and visa system perhaps needs to be looked at, but as a jurisdiction of exit, we're actually incredibly comfortable. It's very low touch from an administrative perspective. So just so long as you get the planning put in place, the actual steps that you have to take in engaging with government and engaging with HMRC are very low. It's a very passive environment. So actually, as a jurisdiction of exit, it's a very comfortable place to leave.
Fantastic. Well, look, gentlemen, thank you for talking to me today, and I look forward to sharing this case study.
Thank you, David.